Thank you for joining us. This is 1031 Exchanges Made Easy, and we are going to take a look at an overview of 1031 exchanges, give you the basics so that you can kind of get a good idea of what they're all about, what are some of the rules, and then we will take a look at the benefits to an exchange and show you how you could really utilize 1031 exchanges and make them work for all of your investment objectives. We'll take a look at what it means when someone says like-kind property. And what are the requirements of that successful exchange? What are the rules? How much time do I have to make all of this happen? And how to maximize that tax deferral. Everybody's goal, the number one goal of doing a 1031 exchange is how do I make sure I save as much in taxes as possible, right? And then, of course, we will talk about what you should look for when you are selecting your qualified intermediary or 1031 exchange company. And then, of course, if you have any questions, go ahead and pop those into the Q&A. And at the end, I will take a look at all of those and answer them at that time. So let's dive right in. What is a 1031 exchange? Section 1031 of the Internal Revenue Code says that no gain or loss will be recognized as long as you are holding that property, that real property, for productive use in a trade or business or for investment. So a 1031 exchange is not going to be for your primary residence, the house that you live in, or properties that you are flipping. It is truly the sale of that business use or investment property, followed by the purchase of another one within 180 calendar days, and it's all linked together by the appropriate and necessary paperwork. And exchanges are not new. They've actually been around and in the tax code since 1921. So at this point, over 100 years. And they are based on the continuity of the investment. So IRS really wants to see what is that initial investment that you made, and is that entire investment continuing to that new property? Is everything going and continuing to that new property? We're going to look at a case study because I think it's helpful to put some numbers and some figures to how do you get taxed? What happens? What are the taxes that are going to apply? And then it's really powerful to be able to see what you were going to pay in taxes and then perhaps what you're not going to pay because you took advantage of 1031. Okay, so let's talk about what are the taxes that you're going to possibly be on the hook for if you were to sell something. So gain, you're always going to have gain, or you're hopeful, I guess, that you're going to have gain or appreciation, right? So your property is going to go up in value, or whatever asset you own is going to go up in value. Now, if you've owned that asset for 12 months or less, you're actually going to be taxed at ordinary income rates, which could be as high as 37%. Once you get over that owning a property for a year and a day mark, you're then subject to the long-term capital gains taxes. Now, depending on the brackets, right, the rate is going to be different. So you could be in the highest 20% bracket, depending on your adjusted gross income and where you fall into these number brackets. It could be a 15% and it could be a 0%. Now, typically, we're not going to know exactly which one you fall into. Your tax advisor would be the best one to make sure that you know exactly where you are in these rates. But I always tell people, just assume it's going to be the 20% bracket. And then that way, when you talk to your tax advisor, they say, actually, you're only in the 15%. Well, then that's a good day, right? So there's also a 3.8% net investment income tax. And that's going to affect individuals, estates, and trusts that have a modified gross annual income that exceeds $200,000. And this is a tax that's actually tacked right on top of the capital gains tax. So again, if we're going worst case scenario, we're now at a 23.8% tax on any gain that you may have in that property. And this 3.8% tax, this actually applies to things that are considered unearned income, which would be things like rental income, capital gains, dividends, items like that, right? And, unfortunately, a lot don't necessarily know about this 3.8% tax. So it's a nice little surprise come tax time when their tax advisor tells them about it. And then, of course, when you own an investment property, there is typically depreciation that goes along with that. So anytime you take depreciation on a property, when you sell that, the IRS says, great, we want 25% of that back. And that is regardless of your tax bracket. So just a straight 25% on whatever amount of depreciation you took while you have owned that asset. That is all the federal taxes. We're not done. There is still state taxes. The good news is when you do a 1031 exchange, if it's a state that has any kind of tax regime, they either follow the federal code or have some version of like kind in their state, and you can defer the state taxes as well. And good news for those that are in Pennsylvania or own property in Pennsylvania, beginning in 2023, Pennsylvania started recognizing 1031 exchanges. Now, prior to that, they did not. So you still owed the state of Pennsylvania, but now you are good no matter where you go in the U.S. So state taxes can be deferred. Okay, so let's set up our case study. We're just going to assume we're an individual and we've owned this property for about 15 years. We have an annual salary of $225,000 and $125,000 of additional income from various sources. We bought the property for $350,000 and we really haven't made any capital improvements to it, but we have taken $150,000 in depreciation and now we're selling it for $600,000. So what does all that mean? It means we've got capital gains of $250,000. And with $350,000 of income and $250,000 of gain, you can see how you quickly get bumped right up into that highest capital gains tax rate of the 20%. And we are also subject to the 3.8% net investment income tax. And of course, we're probably in the highest income tax bracket, which was that 37% tax I talked about earlier. And then the depreciation recapture, we took $150,000 of depreciation. So they're going to hit us with a 25% tax on that depreciation recapture. So as an outright sale, here's what that's going to look like. You're selling for $600,000. You're going to have capital gains tax, and we were actually kind on our slide here and only hit them with the 15%, but that still works out to $37,500 of capital gains taxes. There's also the state tax. Now, the state taxes, they vary from state to state. So it could be 0 all the way up to 12, maybe even 14%, I believe in some potential cases. So we went somewhat middle of the road here with a 5% tax. So let's just assume there's another $12,500 in state taxes that would be due. And then, of course, the 3.8% net investment income tax, that's another $9,500. And we can't forget about that depreciation recapture, which is another $37,500, making our tax liability $97,000. Now, if we take that right off of that sale price of $600,000 and pretend, of course, for ease in our example here, that closing costs, mortgage payoffs, that sort of thing don't exist, that leaves us with $503,000 to work with. And if we were to utilize that $503,000 of equity as a 30% down payment, we could buy a property for $1.67 million, which is a pretty decent leap from $600,000, right? That's going to be a pretty good property. However, if we had done the 1031 exchange, we would not be on the hook for any of those taxes. That would mean we would have the full advantage of that $600,000, that full $600,000 to utilize as a 30% down payment, and we could buy a property $2 million. Well, that's a better property. That property perhaps has more units in it, which means you can collect more rent. Maybe it's closer to the beach if it's in a resort area, whatever the case may be, right? It's putting you in a slightly better position for that investment. Now, of course, the most obvious benefit here is you're not paying the taxes. You're not paying the state and federal taxes. You're avoiding that $97,000 tax bill, which is fantastic. Number one goal of everybody that does a 1031 exchange. I don't want to pay the taxes, right? But it's also giving you the ability to invest all of those proceeds and leverage that additional cash to your benefit and acquire a property that's $330,000 more than if you had just paid the taxes. So if it is that property that's closer to, you're in a resort area and it's closer to whatever the attraction is in that resort area, well, guess what? You can probably charge higher rents from day one. And that's the whole idea, right? If you're going to own an investment property and take on all of that and what goes along with it, being a landlord, managing it, all of those good things, you want to be able to have that investment be a good return for you. And so collecting higher rents from day one, always a good thing. There's also the ability to have more depreciation. So typically when you buy for a higher value than what you sold for, you can depreciate that new higher value. And so that is a good thing. That depreciation on a yearly basis, that is a good thing. Accountants would definitely agree with me. And of course, potentially enjoy greater appreciation long term for that investment, right? It sets you on that path to accomplish whatever investment objectives you're trying to get to. So let's take a look at some of the other benefits to a 1031 exchange, and we'll also get into what are those rules that I have to follow? What's the time frame I've got to make all of this happen? And let's kind of dig into some of those. So again, most obvious benefit, you're not paying the taxes now. You get that immediate tax deferral, but you're also getting the time value of that deferral. You are keeping those dollars in your pocket, those pre-tax dollars in your pocket and working for you instead of having to send that money off to IRS come tax time. You're also avoiding all of your income being taxed at that crazy high income tax rate. That potential 37% that I mentioned earlier. And you're avoiding the 3.8% net investment income tax, which is always a good thing. You're trying to, make sure that you're getting that value when you're doing the 1031 exchange and keeping yourself out of paying all of those taxes. It is also giving you the greater buying power. You're keeping more equity working for you and giving yourself the ability to either have a larger down payment like we showed in our example there, our case study. But the other thing to think about is, maybe your thought was, well, gosh, I'd really like to buy multiple properties. And you can do that. You can get, a lump sum of equity that's going into your exchange and spreading that out across a couple of properties instead of just doing the one larger property. That is absolutely an option. You can sell one and buy multiple in the 1031 exchange, and potentially create new cash flow. So this is illustrated probably best by someone who, let's say they own a piece of vacant land. Maybe they inherited it years ago and it's just kind of sitting there doing nothing for them. And land is inherently considered an investment. So they could sell that piece of land, do the 1031 exchange, and maybe what they reinvest into is a duplex that they rent out or a single family home or something like that. And now it's cash flow for them instead of just a piece of vacant land that was previously sitting there doing nothing, right? Because vacant land is typically not earning you any money on a monthly basis. So now you've translated that via the 1031 into an income producing property. And now you've got rental income coming in, all of those good things. So potentially new cash flow, depending on what your particular situation might be. There's also less management responsibilities. And with a 1031 exchange, most will think of the first properties that come to mind: single family homes, maybe commercial properties, right? An office building, a warehouse, those sorts of things. And you can acquire properties through a 1031 exchange that do not require you to be a landlord and actively manage those properties. A good example of those would be triple net leases. That is something. Oil and gas rights. Or what's called a DST, or a Delaware Statutory Trust. Those are all quick examples of properties that do not require you to be a landlord. And, maybe, you tried the rental game and you thought, gosh, I do not like this, and I don't want to have to manage a property. I don't want to have to collect rent checks. I don't want to have to keep doing that. And you'd like to get away from that active management of a property and move to a more passive investment, which would be those that I just gave examples of. So certainly something to keep in mind with a 1031 exchange, that you can acquire properties that do not require you to be a landlord. There is also consolidation. So I gave the example earlier of going from one large property and then buying multiple in the 1031 exchange, but you can absolutely do the reverse of that. So if you have, let's say you've amassed a portfolio of properties over the years where you own 10, 15, 20 properties, whatever it may be. And at this point, you'd like to start winding that down. You'd like to make it more manageable. Maybe you'd like to buy one or two that are closer to you. You're not necessarily trying to get totally out of the landlord game, but you would like to have something that feels a little less spread out all over the place, so many properties to manage. And so perhaps what you do is sell your portfolio of 15 properties and you buy one or two. And as long as your values are the same on both sides, you can certainly still maximize your tax deferral with the 1031 exchange. There's also, like I mentioned earlier, more depreciation, but only if you're trading up in value. So, when you are contemplating the 1031, you're going to want to make sure that you're talking with your tax advisor to figure out how to best depreciate that new property. How do we approach it? And if you're trading up in value, you have options there. There is also diversification of assets. So, in the instance where you've decided, gosh, I really don't want to do the landlord thing any longer, you could decide, all right, I'd like to buy, through my 1031, I'd like to buy one property that I do still manage, and that's okay. But could I mix in some of those passive investments? And you can absolutely mix and match the actively managed properties and the passive investments. So that is certainly an option. The other thing I like to mention when diversification comes up, sometimes there is a bit of a misconception with 1031 that, if you sold residential, you have to stick with residential properties and you can't switch over to investing in commercial, but you can absolutely mix and match residential and commercial properties in a 1031 exchange. All of those qualify as long as they're those business use or investment real property exchanges. Okay. So for the next couple of bullet points, all the way through to the end, I use a restaurant owner as a good example to illustrate how these could work, and how this really is a powerful strategy, the 1031, and how someone who owns a restaurant can make it work for them and get the best tax benefit out of it. So let's say we're a restaurant owner. We've started a restaurant. We bought the real estate that houses the restaurant, right? You have to keep that in mind. It does need to, at least for 1031 purposes, it has to be the real property. And so we own this building, we're operating our restaurant, and we're actually doing really well. We're busy. We actually are always on a wait because it's not a real big place and we don't have enough seating. And so it would be better for our business if we had a slightly larger property that we could operate our restaurant out of. And maybe there's no parking lot attached to the restaurant. It makes it a little hectic for your customers to park. So they could consider selling the building that houses the restaurant. They do the 1031 exchange and they acquire a property that has more square footage, has a parking lot attached to it, and now their business is thriving even more, and they did not have to worry about taking that tax hit when they sold their restaurant and that real estate that housed their restaurant. And so if we keep going with that restaurant owner, maybe they have now been doing this for a lot of years and they are tired of the restaurant business. They would like to get out. They would like to exit out of that business. And so they're trying to plan ahead and think about retirement. So let's say that restaurant owner decides, okay, I need to wind down. I need to move the restaurant to a new owner, however that may be, and I want to sell this building, and try to move myself into retirement. So they do the 1031 exchange, they sell their restaurant, they do the 1031 exchange, but this time they acquire a property in an area they would eventually like to retire to. So yes, initially, the property that they buy through the 1031 exchange does need to be business use or investment. So let's say, they bought a property in Florida or the Carolinas or Arizona, wherever it is, right? They acquired something where they go, gosh, we're going to retire, and in a couple of years, we are going to move into that property or make it just a strictly personal use property. There is nothing that says that they can't eventually convert the property they acquired through the 1031 exchange to strictly a personal use property. So ideally, they would, for the first couple of years, typically 2 years, they would keep it as that business use or investment. So they rent it out for a period of time, and then they would retire and move into that property and either live there full time or maybe just go there during the winter months if they came from the north. And so that at the time that they move into it, that's not going to trigger any taxes, right? They're simply changing the use of it. So they would simply start reporting it on their tax return a little bit differently. And then if they did an outright sale, that would be when some tax consequences would come in, but not when they just simply change the use of it. So something to keep in mind, right? Some options there. If that's a scenario that sounds potentially familiar to you or something that you would like to utilize. Now, if we keep going with that restaurant owner, eventually that restaurant owner is going to pass away. And at that time, the assets owned by our restaurant owner would actually get passed to their heirs at what they call a stepped up basis, which means that their heirs would receive it at that day's fair market value. And all of the capital gains, depreciation, all of those things that our restaurant owner deferred by doing the 1031 exchange over their lifetime is wiped away. So a lot will use a 1031 exchange as an estate planning tool to try to get their wealth to their heirs without saddling them with a huge tax bill, right? Now, keep in mind that inheritance taxes, estate taxes, those are different taxes than capital gains and the others that I've mentioned. And so those have to be taken into consideration. You would want to make sure you consult with someone on those. But for 2025, the current estate tax exclusion is $13.99 million. So they have a little bit to work with, at least for 2025. Okay. One of the things I mentioned earlier was confusion sometimes around like-kind property and what that really means. It is, a bit misleading with the way that it's worded. Like-kind makes it seem like, well, gosh, if I'm selling an apartment building, I have to buy a like-kind property and buy an apartment building. And it sounds like it somewhat pigeonholes you into a certain type of property, but that's actually not the case. It does have to be real property. That must be true. But it is not about the specific type of property. It's actually more about the nature or the character of the property. So as long as you are holding it for business use or investment, and it is real property, it will work for 1031 purposes. It does have to be in the 50 states, DC, or select territories, but you have all of the US to work with there. And you certainly can sell and buy multiple properties, right? We illustrated that with some of our benefits that we talked through. Some other examples that some of them are obvious. The first couple of bullet points here are the obvious ones, and then some are not as obvious and things that you may not have thought about. I do like to point out with the farms and ranches, just something to think about with those. So typically with a farm or a ranch, you're going to have the primary house, and then a couple of acres around it that might be where the farmer actually lives, right? So that's personal use, and that wouldn't work for 1031, right? We mentioned earlier, the primary residence, your home you live in, that does not qualify for 1031 purposes, but the rest of the property is investment, right? It's an operating farm or a ranch, and so that would work. So they would carve off the primary and personal use portion of the property, and then the rest would be eligible for a 1031. So just something to keep in mind if you are in an area that has lots of farms and ranches. A tenant in common interest, that is referring to the ownership of a property where you are two individuals who own an undivided interest in that property together. So, maybe you own a property with your sibling, and you own 50% and they own 50%, and you each report your respective percentages on your individual tax return. It actually gives you some flexibility if, when it comes time to sell that property, your sibling says, I do not want to do the 1031 exchange, but you do. And so you can take your 50% undivided tenant in common interest, do the 1031 exchange, and your sibling can do what they wish with their half. They can outright sell it, pay the taxes, whatever they're thinking. Conservation easements and utility easements may not jump out at you as something that's eligible for a 1031, but they are. Leasehold interest of 30 years or more, including options. So once you get over that 30-year mark, it's considered real property. The triple net leases and Delaware statutory trusts, those are those passive investments that I talked about earlier. And same with our last bullet point here, the oil and gas royalties, mineral rights, and timber rights, all things that qualify for 1031, and those are some of those passive investments as well. Non-like kind, so things that are not going to work for a 1031 exchange. Personal property. So unfortunately, at the very end of 2017, 1031 was no longer an option starting January 1st of 2018, no longer an option for personal property. So, equipment, fixtures, cattle, things like that, you can no longer 1031, where previously you could. Your personal residence in most vacation homes, if it's strictly a personal use property, you use it with your family, that's not going to work for 1031 purposes. Partnership interests. If you own a property in a formal legal partnership and not all of the partners want to do the 1031 exchange, unfortunately, they can't just take their partnership interest and do the 1031 or not do the 1031. The partnership can absolutely complete a 1031 exchange because at the end of the day, the partnership is what owns that investment. But the individual partners own a partnership interest, and they are not considered like kind for 1031 purposes. Mortgages and notes, unfortunately, they do not work. Cash, that's not going to work either. It's not real property. dealer property and inventory. So someone who is a real estate developer, right? They buy up a tract of land, they subdivide it, and they hold those subdivided parcels on their tax return as inventory. Not going to work for 1031 purposes, right? Kind of held for resale idea behind those. REITs, which are real estate investment trusts. That question gets thrown at us a lot. Unfortunately, the way that those are structured, they do not qualify for 1031 purposes. And then, of course, stocks. We also get that question quite often, and stocks are not eligible for 1031 treatment either. How long do you actually have to own the property before you can sell it and do the 1031 exchange? And technically, there is no set holding period defined in the regulations. We use as a good rule of thumb 1 to 2 years, 1 to 2 tax returns. But more important than the length of time that you have owned the property is actually your intention when you acquired it. So you have to think about, what's the picture I've painted? How have I used the property? How have I reported this property on my tax return? And that's really going to be, some of the factors. It's not just one factor. It's multiple factor. What's that picture that you've painted? And has your personal use of the property been minimal? Right? That's going to be important as well. And of course, you want to make sure that anytime you're contemplating the 1031 exchange, that you're roping in your tax and legal advisors to help you decide, yes, this qualifies, or gosh, no, I don't think this qualifies for 1031 treatment. One of the other big requirements is that you must use a qualified intermediary, or QI. That is what 1031 Corp is. It is a required party that IRS says you have to facilitate a 1031 exchange. And the reason that we are qualified to handle this transaction for you is because we are not a close relative, partner, or anyone that has provided any other service for you, like being your real estate professional, your accountant, your attorney, so on and so forth, for the last 2 years, right? So that's what makes us qualified. And we play an important role because it's our job to make sure that we prepare all of the necessary paperwork. We are setting you up for success and answering all of those questions that you may have, letting you know what are the time deadlines involved in the 1031. Make sure that we're coordinating with everybody involved in the transaction so everyone's aware that it's part of a 1031 exchange. And then one other big piece of it is holding the exchange proceeds and controlling those exchange proceeds. So IRS's requirement, one of them, is that the seller cannot have control of the proceeds from the sale. So typically, when you would sell a piece of real estate, you would walk away with either a wire transfer or a check for the proceeds from that sale. And in a 1031 exchange, those would actually come to 1031 Corp. We would put them in an account that is segregated and set up specifically for your exchange with your name and tax ID attached to it. And those would stay there until you're ready to buy whatever it is you're going to acquire through the 1031 exchange. So some of that documentation that would be involved is a 1031 exchange agreement. That does need to be in place before you go to closing on the property that you currently own, what we refer to as your relinquished property. Right? So before you give up legal title, we have to have that paperwork in place. It's going to outline the relationship between 1031 Corp and you, what we refer to as the exchanger, and then place restrictions on those funds, right? So that requirement that you not have control of the exchange proceeds will make sure that we outline all of the restrictions surrounding those exchange funds and how long they'll be held and how they'll be held and what's required in order to release funds from that account, all of those things to make sure there's protections in place while you are completing your 1031. There is also an assignment of your agreement of sale and an acknowledgement from the other party. So one of the other requirements that IRS has is that the other parties to the transaction, they need to be notified that as part of a 1031 exchange. It doesn't have any impact on them, but they want the disclosure that is part of a 1031 in place and in writing. So we will prepare that document and send it to the closing so that all parties can read it, sign off on it, and make sure that that is in place for your exchange. Some of the time deadlines. If you've seen or read anything about a 1031, this was probably what you heard about it, that there are 2 time deadlines. They start the day you go to closing on your current property, that relinquished property. It's going to trigger, closing date is going to trigger a 45-day identification period. So within 45 days, you need to give us a list of potential properties that you would like to use to complete your 1031. From that same date of closing, you have a total of 180 days to actually get something on that list, that 45-day list, to closing. You have to take legal title to something on that 45-day list. Something I always tell everyone to keep in mind, once day 45 comes and goes, so midnight of day 45 comes and goes, whatever you have on that list, that's what you have to choose from to complete your 1031 exchange. Fortunately, IRS does not allow for any substitutions, alterations, or changes after day 45. Something to keep in mind. Those 45 days do go by quick. Some rules, of course, surrounding the 45-day identification and what you can do. There's a couple of them. The first is what's called the 3-property rule. So you can identify up to 3 properties regardless of their combined value. If you decide you'd like to identify more than 3, you can do that as long as the combined value of those 4 or 5 or 6 or whatever it is that you've put on the list doesn't exceed twice what you sold for, or 200%. So if you sold for, we'll do easy numbers, you sold for $500,000. If you want to list 4 properties, 5, so on and so forth, when you add all of those up, you can't exceed $1 million. Okay? If you decide you would like to break both of those rules, you could still have a valid identification as long as you acquire 95% of what you've identified, which basically means you need to buy everything you put on that identification list. I will say not a whole lot of people utilize that 95% rule, but it is an option. There is also one other thing to keep in mind. Anything that you go to closing on within the 45 days, that's automatically identified, which means you don't actually need to list it out on that form, but you do need to keep in mind that it is property number 1. So if you're planning to buy additional properties, you already have number 1 identified. So if you were going with the 3-property rule, you would only have 2 more properties to work with. Okay. Let's take you through kind of the different steps when completing the 1031 exchange. And the first is you're going to list your property for sale, right? And typically, within that time frame between listing it and getting that signed agreement of sale, perhaps you'll give us a call. That would be a great time. We are always happy to talk through what to expect. But once you get that signed agreement with a buyer, that is when most will call us to actually get the process started. We would then be retained as your 1031 qualified intermediary. Once closing is set up and ready, we would make sure that we're preparing all of the documentation, coordinating with all of the parties involved, the closing agent that's handling that transaction. And once closing takes place, that is we're going to make sure that you have the exchange account set up for your exchange funds so that those can be deposited into that interest-bearing, segregated, FDIC-insured account with your name and tax ID attached to it. So closing has occurred, the wire transfer goes to that account, and that closing is going to trigger the 45 and 180-day time deadlines. Within the 45 days, you would identify the property or properties you would like to use to complete the 1031. And hopefully you can get something under agreement within the 45 days. It is not a requirement that you do so within the 45 days, but it's not a bad idea, right? Kind of give you a little bit of more hope that you're going to be able to acquire one of the properties that you put on that 45-day identification list. So once you've signed that agreement, you're typically going to need an earnest money deposit, and you can certainly use the exchange funds that we are holding to provide that deposit. We need a little bit of paperwork in place, but we can absolutely use those funds for that deposit. We will then, of course, coordinate with the closing agent on the purchase side. You let us know who's handling that closing for you. We'll make sure that we are looping them in. We will wire transfer the funds for your closing. You acquire that replacement property. Your exchange is finished. So how do you really maximize your tax deferral? And in general, you want to make sure that you are acquiring a replacement property, right, the new property, and it has equal or greater value and equity to the property that you sold. Now, let's take real numbers and kind of make a little bit more sense. So let's say you're selling a property for $500,000. They do allow you to subtract off your closing costs to kind of come up with what's that target figure that I need to reinvest. And closing costs are things like real estate commissions, transfer taxes or excise taxes if those exist in your state, items like that, whatever the closing agent company, the title company, escrow company might charge you for handling that closing. Those are the closing costs. Your mortgage payoff, if you have one, is not considered a closing cost, right? So let's just say we're selling for $500,000 and we have $50,000 in closing costs. That would mean you want to acquire a new property for $450,000 or more to really maximize your tax savings. Now, of that $450,000, let's say $200,000 was equity, and then $250,000 was a mortgage that you paid off. So in our new property, you need to buy, let's say you buy something for $450,000, that new property has to have $200,000 of equity or cash, and you can go get a new loan for $250,000. Or if you would prefer to contribute $250,000 of cash from some other asset and buy that new property all cash, you can absolutely do that. IRS doesn't necessarily care how you get to the $450,000 as long as the equity from the one you sold is the same in the new property. You can offset that mortgage with more equity that you contribute. Now, let's just say you didn't quite make it to $450,000, and maybe you only bought something for $400,000. It's not going to make the whole thing taxable. What would happen is that small $50,000 trade down that you had would simply be taxable. So $50,000, you'd be on the hook for taxes on $50,000. Now, keep in mind, you want to make sure that if that trade down or that difference between the number you sold for and the one you're buying for is significant, that it still makes sense that you're doing the 1031 exchange, right? Certainly, you want to make sure that you're actually going to have some tax savings still, and that trade down isn't so severe that you're paying all the taxes anyway. So that's, why we always suggest before you jump into the 1031, talk to your tax advisor. Make sure that it makes sense. Something that you can keep in mind is refinancing your replacement property. So oftentimes we have people tell us that, well, I own the property that I'm selling free and clear. I don't have a mortgage. And I didn't really want to put all of that cash into a new property. Well, if you keep money out of the 1031, let's say you go, I want to keep 100,000. They're going to hit you with taxes on that, right? All those taxes I laid out in the beginning, capital gains, the 3.8% net investment, so on and so forth. You're going to pay all of those if you keep money out of the 1031. But what we have seen taxpayers do in the past, a strategy where, yes, initially they put all of the cash into the 1031 and they buy the new property with all of that cash. But after afterwards, they refinance that replacement property and pull some of the cash out. You would still have to pay for whatever it costs to do the refinance, but at that point in time, you're pulling it out tax-free. You wouldn't be on the hook for all those other taxes that I just explained, capital gains, depreciation, all of that, where you would have taken what we call boot and kept it out of the 1031. So just a strategy to keep in mind if that might fit one of your scenarios. So basis and depreciation, I had mentioned a couple of things earlier on depreciation, but one thing to mention on your basis in the property that you are selling, kind of your starting point, if you will, about your original purchase price, that is actually carried forward to the new property and then increased by any increase in property value. So something to keep in mind, and that's kind of how those taxes follow you and how IRS knows what you owe or what you've deferred in taxes. So something to keep in mind there. And then the depreciation, depending on what your tax advisor says, you might depreciate that new property in a couple of different ways. So if you've got an increase in value, that new asset could be depreciated on a new depreciation schedule. You could have two depreciation schedules going. It's going to depend on your particular tax situation and what your tax advisor believes is the best approach for depreciation in that new property. So just a few more kind of requirements that I always like to share before we wrap up. The exchange proceeds. I know I already mentioned the seller, you as the seller of the property can't have control of those, right? So we make sure that we are setting up those accounts, making sure our exchange agreement outlines how those funds need to be handled. You will have that interest-bearing exchange account where those funds will be held, and then you will let us know I need a deposit. We can release funds. We'll make sure that at the end of your transaction, you have a full accounting of all of the debits and credits and interest earnings, and that will be provided at the end of the exchange, along with a package that has all of your pertinent documents from your transaction. The last big rule, it's called the same taxpayer requirement, and basically just means however you currently hold title to the property that you are selling, that is how you need to buy the new property. So if you sold as an individual, you're going to buy as an individual. If you sold as an LLC, a limited liability company, you need to buy as that same LLC. One exception that is actually quite helpful for a lot of people, let's say you sold a property and you owned it in your individual name, but you really would like to acquire the new one in an LLC for the limited protection that that provides. You can do that as long as that LLC is set up as a single member limited liability company, and the sole member is the individual who sold that relinquished property. And you also elect to have it treated as what they call a disregarded entity, which basically means that it flows through to you individually. It files under your social security number, all of those good things. There's also the option for a revocable living trust and a land trust that function in the same disregarded entity manner. So a couple things to keep in mind. While, of course, we believe a 1031 exchange is a great tax strategy, and of course, we'd love for everyone to do a 1031 on their eligible properties, it doesn't always mean it's the best strategy for you in your particular tax situation. And being a qualified intermediary, we cannot provide tax or legal advice. So you need to make sure you're roping in your trusted advisors to help you determine what is the best path for me, what fits my particular tax situation. And of course, we are always available to have conversations and jump on conference calls or, a video call, whatever suits you best, to talk with you and your advisors to help talk through the different requirements for a 1031 and, be a helpful ear for your advisors, of course. When you are looking at choosing your 1031 company, right? You want to make sure, are they going to be my partner throughout the exchange? Are they going to tell me what to expect, how to successfully get through and manage the 1031? What are the different rules I need to follow? Are they going to keep my professional advisors aware of what's going on and make sure everyone's being kept in the loop, that the closing agents know it's part of a 1031, they know exactly what to do, make sure that you're aware of all of the time deadlines and give you those reminders when they're approaching. And most importantly, making sure that there are security measures in place for your funds. So the qualified intermediary is setting up those accounts and holding your funds. So it's someone else holding your money. You want to make sure that you are as comfortable as possible with someone else holding your money. So make sure you ask lots of questions. How do you hold my funds? What protections do you have in place? If it's an FDIC insured account, well, what if it's over the FDIC insured limit? What happens then? Is there additional coverage that you could give? Ask all of those questions when you are vetting your 1031 QI. And of course, we want to make sure that the process is as simple as possible for you. I know I went through a lot of different rules. There's a lot of steps. There's a lot to remember with a 1031. Choose a QI that's going to make it simple and make it an exceptional exchange experience made easy. Of course, we're here to always answer your questions and make sure that we're anticipating your questions that you may have. And of course, our team, we have the experience and the expertise to facilitate even the most complex transactions. We have CES designees on staff. CES stands for Certified Exchange Specialist, which means that they needed to be in the industry for at least 3 years and then take an exam that proves that they know what they're talking about. They are now an expert in that field. We are knowledgeable in all the local real estate and closing practices. We are headquartered, yes, on the East Coast here, but we do have team members throughout the U.S. and another office location on the West Coast. We also make sure that the security of funds is absolutely superior. I know I keep stressing it, but make sure that you are asking the questions about how those funds are being secured while they are with the QI. And of course, making it as simple as possible. So to wrap up, 1031s, they truly are a great wealth accumulation vehicle. You have, been given examples throughout the presentation about how you can build that real estate portfolio using those pre-tax dollars. Keep those dollars in your pocket working for you and get to those short and long-term investment objectives. The more that you know about 1031, the more you can benefit and the more you can make it work for you. We are always happy to talk through your particular scenario and try to help you figure out what's the best strategy for me and how do I make 1031 really work to my benefit. Okay, so that is all we have for the prepared part of the presentation. Let me see.